Good afternoon, everyone. Hello, and thank you for joining us for this Geek Out session on tax considerations. We are ending our 2023 series here at the end of the year to talk about tax considerations. If you guys are like me, you're starting to think about and maybe dread that pulling together the tax data for next year. And we want to talk specifically about tax considerations when you sell your business. I will also say if you're in acquisition mode, think about these things from the other perspective. So we regularly advise clients on both sides of the transaction. We know that our activity is huge from a seller's standpoint because the market is at an all-time high, and you guys have heard me say that for several years now, and I say it every year, and it's still true the next year. So a lot of selling activity. There's also a lot of growth activity, and we know that the majority of the nation's largest companies have huge growth plans in place for 2024. We expect that the rest of you guys do too, and we're super excited about that. We've never seen a higher demand market. So we are navigating, of course, the ability to serve that demand with strategies for staff. And this will be very interesting, I think, from a standpoint of what difference it makes when you run a process. Your tax decisions can impact greatly your proceeds. So there's a lot more strategy that goes into a process than just how much money are you going to pay me? There are 20 other very important things, and one of those is how it's structured from a tax standpoint. So I got my very early start in public accounting, as did my guest speaker here, Henry Taberi, who I'll introduce in just a minute. It's been many, many, many years since I practiced in tax and audit, so I don't pretend to stay current with very detailed tax laws. However, we do know really well the tax laws as they pertain to transactions, because that's an important part of our work, and I consider Henry to be a masterful part of that. So thank you for joining the Hinge team here at the end of the year to talk about this important topic. A couple of there's the Hinge team. We're growing quickly to support your demands. A couple of people missing here. We have about 23 on our team now, between our transaction team with our attorneys and financial advisors and analysts. We have a marketing and development team, and of course a success services team that helps with certain things that I will tell you some of those about. So in our success services, we have been thrilled for the past 2 years to open our sprint series. Our company sprints are booked up maybe through 2024. I know the first quarter is crazy, and you guys have been very gracious in your reception of that as a strategy to build your team, and we're thrilled about it. The Hinge team is also going through a second round of sprints beginning in January. What we do have available is what we call our solo sprints. So we have a lot of business owners or managers who would love to participate but don't have a team quite big enough to do their own sprint. So we've been thrilled with the success of this solo sprint. It's been a great way. What solo means is you're just joining as an individual. We found that this group get to know each other really, really well, and it's a great support group. And then they're taking those concepts back to their own team. So there is some opportunity for that series. Scan the QR code here if you want more information, or go to our website at hingeadvisors.com. You can always email Tom Wood or anyone on the team, and we'll get you to the right place. So we're excited about that opportunity. We also, another part of our success services team is our financial coaching team. This fine group of people here works with business owners and help them set a benchmark and a budget for their company. They coach them regularly on strategies to help their company be as financially healthy as possible. And they do have some capacity and also offer a free consultation. So you can use the Hinge Advisors financial coaching link, or again, anyone on the team can get you aligned with Christine and team. These guys also, we work together to create a QuickBooks format specifically to early education advisors. And so these guys offer training on your QuickBooks system. They also will work with you to either set up your QuickBooks in a format that Hinge recommends to make it easy for you to benchmark your company and see where you might be able to make some slight tweaks to be more financially healthy. And then they offer cleanup of QuickBooks as well, because some people, me included, so I'll get in there with you on owning this one, but sometimes I do some crazy things in QuickBooks and go back later and wonder where all those expenses came from. So they can also help you clean up, get your books in good shape, and move forward. This is a great time of year to consider things like that as you're moving into 2024 and want your books to be clean. Follow us on social media. That's where we announce things like our one-day Thrive event that's coming up the 1st of May. That registration opens in February. Thrive is our one-day financial deep dive. It was how we got our start in events. We love that event. We look at your numbers in advance. Excuse me, we meet with each business owner individually the day before the event. We have a very fun evening together, and then we do a whole day, a very deep dive into your financials and strategies to work with what we consider to be the 5 pillars of your financial health. So we are in Philly this year around the 1st of May. And again, that registration will open in February. If financial acumen in a very simple industry specific way is something that you could benefit from, then you will really like this event. We limit to 100 attendees to give everyone individual attention. And that one sells out quickly, as does our annual Shift conference, which will, that registration will open in August. So I would like to introduce my very good friend and also someone I respect immensely, and the ability to help business owners with the sale of their company. And he's also our duty expert on everything tax. And he's my go-to when I need to say to someone, how would you structure this deal to give this client the very best tax situation? So I'm happy to introduce Henry Tiberi. And Henry, thank you for being here. I will let you tell our guests more about you and your background. And I will see you in a bit to help moderate some questions.
Okay, well, thank you, Kathy. Can you hear my dog?
A little bit, but your dog maybe is okay to contribute if.
Okay, she decided to join me just as I turned my my microphone on. So as Kathy said, my name's Henry Tiberi. I was a tax CPA for Ernst & Young a lifetime ago, and in 1990 I wanted to do something more interesting, and I joined a company called Children's World Learning Centers in 1990. Some of you may be familiar with that. That company ended up merging with Childcare in the early 2000s. We had about 600 locations at that time. I haven't practiced as a tax CPA since the 90s. And so one of the qualifiers is that I can't give you tax advice. I'll give you tax ideas. And you can go talk to your CPA and say, this guy Henry suggested this or that, and they can tell you if I'm right or wrong, or if it works for you. So The first slide here, as you can see, it doesn't work this way. You don't get a pile of cash when you sell your business. It would be great if you did. Unfortunately, a good portion of your sales price when you sell your business is going to go to the tax man. So, next slide, please. So like any good plan ahead. And when we talk about tax planning, it starts at the beginning is what's your ownership structure? Typically a childcare business is owned through an LLC or an S corporation, particularly if it's closely held. And these are known as pass-through entities because the income tax is not paid at the entity level by the LLC or the S corporation. The income passes through to your tax return, typically on a K-1, or you can file with a Schedule C if you're a sole proprietor and you pay taxes on your 1040. Usually what we see is if the real estate is also owned by the business owner, there's a separate real estate entity and it leases to the LLC or the S Corp. So you've really got three different entities. You've got yourself, your individual personally, you've got your business entity, and if you own the real estate, you'll have a third entity, which is the real estate entity. The lease payments that the business pays to the real estate entity are treated as an expense on the business. Typically what we like to see is 10 to 15% lease payments relative to revenue, so 10 or 15% of revenue. And you can talk to your tax CPA about what's best for your tax situation, but the rent you pay should be tax motivated. I'm gonna maybe that'll be better. Okay, so we typically see 10% to 15% of revenue is your rent expense. And so why do this? Well, schedule the rent revenue and the rent income ends up on your Schedule E, which is not subject to self-employment taxes. And that's the main reason why you want to reduce, move that expense to your Schedule E, and pay tax on the rental income without paying self-employment tax and reduce your personal income. And the self-employment tax can be substantial. It can be 15%, depending on your level of income. It will phase out at a certain point at $160,000 typically. Next slide, please. So when you're working on tax planning, my next question is, are your books in order? Do you know where your tax returns are? Do you know where your P&Ls are? Do you look at them other than just looking at your revenue? Do you review your tax adjustments with your tax CPA at the end of the year? And these are typically going to be recategorization. A lot of people expense loan payments, and they're really a balance sheet item and don't belong on your P&L. You should be reviewing these with your tax CPA mid-year to talk about tax planning strategy. Maybe you should go out and spend a bunch of money and Section 179 your purchases to increase your depreciation and reduce your taxes. But these are, it's really important to know where your financials are and have a handle on what those adjustments are at the end of the year. What's in your expense categories. Next slide, please. So the next topic is your what we call your add backs. And your add backs are your discretionary expenses. And I always ask people, do you know what your discretionary expenses are? And they'll generally have an idea, but they've been running personal expenses through the business, and there are a lot of personal expenses you're allowed to run through the business. But when you go to sell the business and we try to tell the buyer that there's a certain amount of discretionary spending, we need to be able to substantiate this. And some people do such a good job burying their expenses in their P&L, their personal expenses, that when it comes time to sell, it's hard to find them or substantiate them. You know, I've had clients take their monthly credit card payment, pay it through the company, and it's a mix of personal and business expenses, and then we use the term sprinkle, they sprinkle it around without really looking at the amounts or the receipts and how to best categorize it. And discretionary expenses are, the definition of discretionary expenses is all the money that an owner has at their disposal to spend on themselves and perks and salary that are not germane or necessary to run the business. And one example is your personal vehicle. You're allowed to expense your personal vehicle through the business, but the business could survive without that. And if we go to sell the business, we're going to tell the buyer that the business can survive without these expenses, and therefore we add them back to income and improve the bottom line. Minimizing tax liability is a strategy all business owners think about. When it comes to selling, though, buried expenses and assets can create a problem in determining cash flow. So what we're after is boosting your EBITDA number as high as we can. And when I say as high as we can, we need to be able to defend that. So documentation of discretionary expenses that you're running through the business is key. And quite often, if you're considering selling the business, that's time to start changing some of your practices and show up. You'll pay more taxes, which is painful, but you'll increase your bottom line and you'll increase the sale price of the business. And some typical discretionary spending is your travel expenses. Sometimes people go to a conference down in Cancun, or in meals and entertainment. Quite often, some of the food expenditures for the business end up going home with you. Repairs and maintenance, supplies, gasoline. It's not what we see is that what's expensed isn't always for the vans. People run their personal gas purchases through the business. And if you think about it, if you've got about $50,000 of personal discretionary expenses that you're running through the business, if you're in a 35% marginal tax bracket, you're going to save $17,500 a year, which is great. But if you go to sell the business and you can't substantiate that discretionary spending and convince a buyer of that $50,000 is discretionary and not necessary, that $50,000 could take $300,000 off your business value. So would you rather have $300,000 when you sell the business, or would you rather save $17,500 for the last few years? If you properly document, you can quite often do both. Next slide, please. That's actually one we just covered. Next slide, please. So the deal structure. If you ask your CPA about selling your business and you bring up an asset deal versus a stock sale, they'll probably give you the textbook answer, which is sell the stock. And the reason they suggest you sell the stock is that all the gain on the sale of the business then is capital gains, which has a maximum tax rate of 20%. If you do an asset sale and you end up with some ordinary income, we can talk about that in a minute. But if you end up with some ordinary income, your maximum tax rate is going to be 37%. So it's about half the taxes on capital gains is ordinary income. The reason why a buyer is not going to be very excited about buying the stock of your company, or when I say buying the stock of your company, it's buying the entity. So an LLC may not have stock, but they'd buy the entity. It's the LLC itself, not just the business name and the goodwill and the furniture, fixtures, and equipment. They'd buy the entity that owns those assets, and that's how they would take possession of them. And they don't like to do it because they inherit your tax base. So if you've already fully depreciated your furniture, fixtures, and equipment, they don't get those deductions. They're stuck with it. The other reason they have been resistant to doing stock sales traditionally is liability. Everybody's afraid that you might have a lawsuit from a year or 2 years ago where little Johnny broke his arm on the playground and he was going to be a Major League Baseball star. And when the company buys it, if they bought the stock of the company, they pick up that liability. What we have seen, we've seen a positive trend in the last few years where buyers are willing to buy the stock of your company. And what they'll do though is they will contract around the liability and have some pretty significant indemnifications that they're required for you to make, and guarantees. The other thing they'll do is they'll ask you, well, we'll do it on the condition that you do a Section 338H election, and a 338H election essentially negates the tax benefit of the stock sale, because you're then required to treat the sale as if it was an asset purchase agreement anyway. So that's the difference between those. The objective when you're selling the business is obviously to maximize the amount of cash you get to put in your pocket and go travel the world. And typically the emphasis is on getting your gain, or your income, categorized as capital gains instead of ordinary income. Capital gains tax up to about $500,000 is there's a de minimis amount where you don't pay any taxes. Up to about $500,000, it's 15%, and then it jumps to 20%. And those brackets depend on your tax status. And as I mentioned, your personal income tax rate's 37% if your income is over $600,000. So the other things tax-wise, the other one other mention that we've run into recently tax-wise is what's called a Type F reorg, and that we typically say this if you have an S corporation and you're selling to a larger company. A lot of large companies can't take possession of an S corporation, so if they're doing a stock sale, they have to reorganize it, and this could significantly slow down your transaction. So I ought to mention that they still do stock sales, even though, and it still makes sense, even though you've got Section 338 and Type F that negate. The 338 negates the tax benefit of it, and the reason to do it is operations and licensing. Quite often, you can get through the licensing process significantly faster if you sell the stock of the company. The buyer is buying the entity, and if the entity name and tax ID doesn't change, in many states, you don't need a new license. There are some states that interpret that as a change of control. A change of control triggers a new license and having to go through the entire process. Next slide, please. So how do we reduce your taxes in a situation where it's an asset purchase agreement or a stock sale with a 338H10 election? Well, one thing that you have to do when you sell your business is you have to file a form. It's a 2-page form. It's form 8594. And you have to report that you sold your business, how much money you got, and how that purchase price was allocated. And if the amount allocated to the furniture, fixtures, and equipment is greater than the tax net book value of the furniture, fixtures, and equipment, you're going to have what's called recapture tax up to the original purchase price of the furniture, fixtures, and equipment. And that recapture tax is treated as ordinary income. So I just said quite a bit there. Tax net book value is what you paid for the business less how much you've depreciated over time. And my guess is that most of you have depreciated, fully depreciated or close to fully depreciated your furniture, fixtures, and equipment. So if you own the real estate and you own the real estate in a separate entity, that entity is going to have to deal with recapture tax separately. But when we're selling, and you're not going to have to file an 8594 for a real estate entity, but for a business you will, which is another reason to keep those items separate. What we strive to do with a purchase price allocation is to minimize the amount allocated to the furniture, fixtures, and equipment. So you've got furniture, fixtures, and equipment, and then typically the other asset category is goodwill. And goodwill is good because goodwill is taxed at capital gains rates. So but there's a yin and a yang here because the buyer is going to prefer that the FF&E, the furniture, fixtures, and equipment allocation, is high because they get to depreciate that over a relatively short period of time, 3 to 5 years, so they get their tax deductions earlier. Whereas goodwill, they get to amortize goodwill, but it's over 15 years. So there's a tax timing difference for the buyer. For the seller, there's a tax difference, and it's not just timing, because if you end up paying ordinary income at taxes at 37%, that money's gone forever. So what we often do in our negotiations is bring up purchase price allocations. Many buyers want to put it off until you're well into the contract or closing, or even after closing, and we try to get that on the table when we can. So that covers Form 8594 and recapture tax. Let's see, next slide, Kathy. That's it.
Thank you, Henry. I would love for you guys, I have some initial questions, but love for you guys to put any questions that you have in the chat box, and Henry and I will attempt to tackle those. As you can see, tax considerations in a transaction is very complicated. And when I listen to Henry, I think my key takeaway is always, I need someone who does this every day and knows what they're doing. So as you can tell, from a transaction standpoint, your advisor should know information like you just heard from Henry and be able to help support your personal tax advisor, tax strategist, the person who does your taxes, and helping to make some decisions about the type of sale and how the allocations go. And there are a lot of considerations, as you can see. So Henry, first question, could you explain EBITDA, and especially the tax component of EBITDA? What taxes are we talking about?
So EBITDA is earnings before interest, taxes, depreciation, and amortization. So the I is interest, the T is taxes, D is depreciation, and A is amortization. And EBITDA is a measure of cash flow that a non well that a buyer would enjoy if they bought the business and did not work in the business. So this assumes that there's a self-sufficient on-site manager. And I'll just mention the other, and there are other metrics when valuing cash flow in business. Is another one is seller's discretionary earnings, SDE. SDE is a measure of the cash flow that I would enjoy from a business if I was the owner operator. So the big difference between those two numbers is whether or not I hire a manager. And the smaller the business, the more often you see it sell on seller's discretionary earnings, because the smaller the business, more likely the owner is going to be an owner operator. So in the EBITDA formula, we do not take into consideration any taxes related to income. We want to see what cash flow is before taxes, and it's similar with interest. The concept is that everybody's financing situation and tax situation is different and unique. And if I have a boatload of cash and I go and buy a business for cash, I'm not going to have any interest expense. And if I'm really shrewd and I figure out, or I've got other businesses where I've got losses, I may not have any taxes. So to create an even playing field, you when you look at the business, you look at it exclusive of the income tax and the interest, the financing cost. Now you still do deduct, you include in the formula. When I say include, you reduce your income by things like property tax or sales tax, because a buyer, regardless of their situation, their tax situation, they're going to pay those same property taxes regardless. So
Great. Thanks, Henry. Another question. Do you have advice specific to someone who is selling the business in FF&E only because they do not own the facilities? Well,
call Hinge, because we can help get the best value for your business, is my number one advice. There's not much you can do if you don't own the real estate. You're going to sell the business. You can't push value to the real estate, which is what we often see. And sometimes we see the real estate value goosed up significantly. The advice on the real estate is have your lease in order. You might ask for what's called an estoppel certificate prior to selling, so that the landlord will acknowledge all the terms, because you don't want to get under contract and then have the landlord question the terms. And be aware that if the buyer is assuming the lease, which they typically do, if they ask for anything, any change, let's say there's 5 years left on the lease, they typically want 10 years. So if you only have 5 years left on a lease, someone's going to have to open up negotiations to discuss a 5-year term extension and maybe some additional options. And as soon as you ask your landlord for something, that opens the door for them to start asking you for things. And we've seen some heartburn with lease negotiations and transactions. And we like to get ahead of that and get to the landlord early on, because if you wait till the 11th hour, they've got all the leverage. As far as tax planning goes, I can't think of anything that you can offhand that you should be doing specifically that I would do different with the business entity.
Right. So I think that everything you mentioned up until this point and in your presentation works equally with a business seller that owns their real estate and with a business seller that leases their real estate. All of those concepts apply to both. I think the only difference would be that there's some additional strategies we might take if you own your real estate. Like Henry said, we might maximize the rent. So there's also a question about, does it matter how much rent I pay myself when I go to sell my business? So do you want to, so that's what we're talking about, right, Henry, that we very often adjust that rent to a higher rent, but you want to speak to that as well?
Sure, sure. So I'm just wondering if I have any other advice on somebody who doesn't own the real estate. You know, the tax planning on the business is the same. As Kathy mentioned, you just don't have the additional opportunity or flexibility to use the real estate as a way to move some value to real estate in an effort to minimize taxes. I'm sorry, Kathy, you asked about.
Okay, so the question was, does it matter what rent I pay?
Oh, rent, the amount of rent. So it really doesn't matter how much rent you've been paying yourself. If you own the real estate, it's not an arm's length transaction. And when we pitch the business to a buyer, and if you own the real estate, they will understand that it was not an arm's length rent, and we can adjust it. And we'll typically adjust the rent to 10 to 15% of revenue, depending on what you've been charging yourself and what your EBITDA is, because there's a balance here. If we push up the rent, we reduce the EBITDA. But if we push up the rent, arguably to a third-party if there's a third-party landlord, a higher rent translates to a higher business or a higher real estate value, and we can argue for a real estate value that's higher. The downside is that we've reduced EBITDA and we've reduced the business value. But doing this quite often ends up in an overall a higher overall business and real estate value combined. And in reality, this is how many of the buyers look at it. Childcare and Learning Care Group and many of the other national and regional buyers and owners do not own the real estate, and they don't want to own the real estate. If you want to sell your business in real estate, they'll often bring in a real estate investment trust, a REIT, and they'll bring that entity to the closing table, and they'll take possession of the real estate, and then they'll lease it to the operator at a cap rate. And the logic is that the operator their focus is growing the business, not the real estate portfolio, and they get a higher return on the investment they make in owning childcare centers than they are paying than the return that they're paying to the real estate investment trust. So, and one strategy is to keep the real estate. Many of the owners we work with just want to distance themselves from everything. They don't want the real estate anymore, even though it typically becomes a triple net lease, and they don't have a lot of the landlord responsibilities. And they'll sell the real estate along with the business because of that. So we make that adjustment when we do our valuation, and we run through iterations of what's the best mix of increasing or decreasing rent and how it impacts EBITDA and overall value.
Great. Thanks, Henry. Let's see, next question. how should I account for personal expenses? So do you have any advice on, I'll have to say that in a sales process, personal expenses are not judged in the least. No, we don't judge, buyers don't judge, you shouldn't judge if you're buying a company. But like Henry said, you do have to substantiate those. So if you're buying a company, you will certainly want to know that you can prove that expenses they say are personal are actually personal. Henry, do you have some advice on how to account for those in your books to make that easier?
Yeah, the best thing to do is the more detail, the better. I have seen where people just they get a $10,000, $15,000 a month credit card bill, and they automatically sprinkle it around, and I've seen them do this, put round numbers, 2,000 here in supplies and a thousand in meals and entertainment, and they actually don't look at the detail on the credit card statement and parse it out and categorize it to the different accounts. So the more detail, the better. It's like Kathy said, there's no judgment. A lot of these personal expenses are legitimate expenses, although they're discretionary because they're not necessary. If you go to an AELL conference and you spend a lot of money traveling, that's a legitimate business expense on one hand. On the other hand, I would argue to a buyer that it wasn't necessary, it was discretionary. So the more detail, the better. You want to be able to put together a spreadsheet for the buyer that lists everything that was personal and why. And I know that makes a lot of people uncomfortable because they don't want to share that with particularly the IRS in particular, because some of those expenses may not actually be legitimate. I like to, without giving tax advice, I like to tell people that if you're going to run something through your business, at least make sure you could make some defense of it, even if it's a weak defense, even if it's a stretch. So, I've seen people who run most of their groceries through, but don't start running cigarettes and alcohol through the business and call it groceries, because that one you're not going to be able to defend. So
some good ditches there, Henry. Okay, next question. If I'm a buyer, should I buy stock?
Well, since I'm representing the seller, heck yeah.
You're answering the buyer, so I think we should answer their question.
Yeah. So it depends. A lot of if you want the transit, particularly, it depends on the state you're in. If a stock purchase gets you around licensing, it makes everybody's life easier. So yes, you're gonna do due diligence and review insurance records and get comfortable that there are not significant events that are going to come back and bite you as a lawsuit. And what I'll tell the sellers is keep in mind that if the buyer is a large national or regional operator, what could quite often happen is, I used the example of a kid falling off the playground and breaking his arm, and the parents think he was going to be a major league pitcher. If that happened while you were the owner and you're in the community and you're in the center and people know you personally, that family is going to be less likely to attempt to sue you. If all of a sudden Childcare or Learning Care Group or one of the large operators who have the perception is they have deep pockets comes on the scene, and if they've purchased the stock, they own that liability, and they're concerned that they may get sued. So as the buyer, you really have to consider, do I have a target on my back? So as long as, if you're the buyer, sure, buy the stock as long as you're comfortable that you've done your due diligence, and the seller had a good, clean record without a lot of drama in the last 5 or 10 years, and insurance claims. If you get a strong indemnification, including maybe a personal guarantee or a significant holdback, sure, buy the stock.
Okay, all right. I have one more question. So if you guys have any more, throw them in the chat, but this might be our last one. What can I do today to minimize tax when I sell in the future?
What can you do today? Well, we went through the list of the different, talk to your tax CPA about your organization structure. You might want to make some changes there. One thing to mention, we don't see it often anymore, but we used to see this a lot. If you were a C corporation, if you started your company as a C corporation and you had a subsequent date elected S corporate status, that's a really important fact for your tax CPA and for Hinge to know, because you may end up being treated as a C corporation when you sell, even though you're now an S corporation, and there's something called double tax that you get hit with. So you want to make sure that you understand your tax organization structure. You want to understand what your tax net book value is, so you know what your objective is in a purchase price allocation. From a tax planning standpoint, it's hard to tell somebody start showing more income and pay more taxes, because people don't want to do that. But in the end, it may end up getting you a higher business value. And we see that more with businesses that are purchased by individuals or smaller entities that get SBA financing, because by and large, most of the buyers at Hinge deals with don't focus on the income reported on the tax return. They focus on the P&L. But if you're selling your business to somebody who's getting an SBA loan, you're not going to have a lot of luck convincing the SBA lenders that those add backs were really discretionary. The add backs you want were discretionary, and that they should allow those add backs. They're much more strict about adding back. So depending on the size of your business, that often has implications for who the buyer is. If your business is a license capacity of 50, you're probably going to sell to a local mom and pop operator who may be getting an SBA loan. And in that case, tax planning wise, you definitely should start reporting more taxable income.
Fantastic. One more question. When selling a real estate LLC, can you use a 1031 exchange on more than one like-kind investment property to eradicate tax consequences? So the question is, so maybe explain a 1031 exchange, Henry, and then answer the question about whether you can use it to invest in more than one property. Okay.
So a 1031 is also known as a Starker exchange or a like-kind exchange. And the concept is, if you're selling a business asset and replacing it immediately is within 180 days, you can roll the gain into the newly acquired asset. So you're deferring the taxes you essentially reduce the basis of the asset that you purchase. So what you just need to know is you don't pay taxes now. The basis in the new asset is lower, which so when you eventually sell that asset, your gain's going to be higher, and then you end up paying the piper. It's a tax deferral mechanism. It's not tax avoidance, and you can sell a property, roll the basis over, the gain over into that property, and you can keep doing this and buying more and more properties. And yes, you can buy multiple properties in a 1031. It gets complicated. The rules of a 1031 are once you sell, you have to identify a property within 45 days or properties, and then you have to close on the new assets within an additional 145 days, so it's 180 days. You should get tax advice on this, but you need to spend all the cash proceeds. You need to buy something more expensive and put all the cash proceeds into it. And the IRS is fairly liberal on what like kind means. And this actually applies to, technically you can do it with your business. If you sold your business and went and bought another business, you could do a 1031. They even let you do, there's rules about livestock. You can sell cows and buy horses under a like kind. You just can't do, for some reason, they can't be of different sexes. I don't know why, but you can't sell a cow and buy a bull and do a like kind. So the answer is yes, and it's a great mechanism. You can sell your childcare center and buy something like a Starbucks building that's on a long-term triple net lease, and it's mailbox money. It's a great way to go. The other thing about a 1031 that's nice is if we can push value off. If you're selling the business and the real estate, and we can push value from the business to the real estate, that's a way to shelter that gain and defer the taxes on it, because you can do it's easier to do a 1031 on real estate than selling a business. To do a 1031 on the business piece, you have to want to go out and buy another business.
Great.
So somebody did ask another question. I see, Kathy. Demand for smaller centers. The regional and national operators, way to think about it is most of them want to buy more of what they have. So they often have a 8,000 square foot center license for 140 children on a main feeder road in a suburban neighborhood, and that's really what they want. We don't see them buying a lot of schools under 100 capacity. I sold one single location last year with probably an 85 to 90 capacity, and they were doing about $1.2 million in revenue, and that's kind of on the low end size wise for those buyers. We don't typically sell the smaller centers, although I'm very happy for people to call me if you have a school license for 50 and you want some advice on how to sell it and what it might be worth. I'm very happy to give you and most of the Hinge team is available and happy as well to chat with you about that.
Yeah, let me add one comment to that, Henry. So the short answer to the question is there are buyers for every type of business. It's just who is the buyer is what Henry was commenting on. So if your capacity is lower than some of the serial buyers that Henry mentioned, the national groups, international groups, and regional groups are looking for, then your asset is a better fit for a local buyer. And those require a different type of marketing and a different type of advisor to find you the right buyer. So again, reach out to us if we can give any more information, because all assets are valuable and there's a buyer out there for every asset. It's just, who is it? And what is the best mechanism for finding that person, and who is the best advisory group to support you through that process? So two more, Henry. Well, back to the 1031 process. Do you have to buy in the same amount you sold for, or can you get some cash out?
Okay, so I'm going to caveat this with, talk to your tax advisor or the intermediary. Most people go through an intermediary when they do a 1031, and that intermediary holds the money. You're not allowed to touch the money. You're not going to be able to take cash out at the closing of the sale of the property, typically not. But the simple way to get cash out is you either refinance the property, or to take a loan out on the property prior to selling it, or after you sell it. So what the IRS wants to see is all the cash that crosses the table gets reinvested, and there's less cash crossing the table if you've got a loan on it. And if you don't have a loan on it, the thing to do is if you need some cash, is sell it, roll the money into the new asset, and they don't want you doing it the same day. But within a reasonable period of time, you can take cash out through a loan.
Right. Okay. One more. So there's also a question about whether we help people buy childcare businesses. I'll just answer that real quickly. We don't represent buyers, and it's just a capacity issue. What we do is bring sellers to market in a competitive process, because we have a huge buyer database of over 500 buying groups that will compete for assets and give them the very best value possible. We are always happy to answer a question. You heard Henry say that, sometimes people who are looking at something to buy will call us and say, what do you think about this? And we can give some general advice. What we don't do is represent buyers, but thank you for that question. Do you want to add to that, Henry?
Yeah, Kathy, I will add to the person who asked about whether or not we help buys. Make sure you talk to us and get on the list, because although we won't go out and seek centers for you, we want to help you buy, because we want to help the seller sell. And just remember, we're on the other side of the table, but we're going to work hard to help you to buy schools if we have them for sale.
Really good point, Henry. So in my head, I was thinking they've identified a school and looking for representation, but Henry has a really good point that individuals, we add individuals to our buyer database all the time, and we make notes about specifically what they're looking for. And even though we don't go out and solicit sellers, they typically come to us. We very regularly have things in individual markets where someone might have an interest where they might not in other markets. So thank you for that question.
Yeah, and Kathy, I'll add that we've helped operators grow their business by bringing deals to them. We don't bring them the deal exclusively, but they buy deals through us, and we've helped them grow, only for them to call upon us to help them sell when they get to 5, 10 or so centers. So
good point.
We're happy to do that.
Good point. And we are out of time, Mr. Tiberi. Thank you very much for your brain space today. That was great information. And again, I hope that you guys understand the value of the person who strategizes with you on your tax situation. We get asked that question a lot. I have someone who can do my financial statements and can file my tax return, but where's that person who can sit down with me and give me good strategies on how to operate better and how to get myself ready for an event? The Hinge team can support, but also those people are out there. I've got the most fantastic tax advisor, and you guys heard me say that even though I formerly worked in the tax arena, I wouldn't begin to file my own tax return, and I need a strong advisor as well. So we feel like that is a very important person in your toolbox, and also the Hinge team would like to be a part of that as well. So take care and be well, friends. Thank you for joining us. Hope you have a happy holiday, and we will look forward to being a part of your business success in 2024.